One more time. Now that you can see my screen. Ignore that first 8 minutes of the class. Okay, the inverse branch generates $1 million of pre-tax income, £1 million, excuse me, of pre-tax income. So coming down here, we're going to put in the $1 million. Pre-tax income is £1 million. Nice, but pounds. And the foreign taxes paid will be 1 million times what rate do you think for converting it? It was paid on December 31st, so that would be the date we would use. And the rate was 135. Wait a minute. I did this completely wrong. Wait a minute. I know I still gotta convert it. I'm sorry, I gotta do the 15%. What do I do here? I'm sorry. I come back up here. 15% times 1 million pounds. Equals 150,000 pounds. So that's the tax rate. That's how much taxes they paid. 150,000 pounds times the rate gives us some different number. Okay, so this is that number. Okay, their net income would be the million pre-tax income minus 150,000 pounds. So looking with 850,000. Now this 850,000 though was earned throughout the year. So we're going to use the average rate for that. So 125. So in US dollars, that would be some number. No, 1,062,500. Oh, I know what it is. It's those things underneath. Okay, so now notice what's going on here, that we have, these are 850,000 pounds. And notice that these are actually at two different rates. Why? Because the 1,500 pounds was taken out at the $1.35 rate, whereas the 150,000 pounds are earned throughout the year at the 125 rate. So these were actually taken out at, in this case, a higher rate than throughout the year. And notice that this is an expense. So this will actually reduce the total amount that we're going to pick up for our income. So we're going to take these two and add them together. And that's going to be our taxable US income. So 1,265,000. Okay, now you could multiply it up here, 25% times, and I'm going to do it down here, but it's the same thing. So this will equal okay, so it's going to look like this. The foreign income taxes paid was this amount. Paid 15% taxes, and this was the exchange rate. The USS rate was 25% times this taxable income, which is that, sort of like this. These are gonna be in dollars, US dollars. 316. Okay, so these are the two we're gonna compare. Now, we always pick the lowest one for the foreign tax credit. And you say, well, why? Well, because it's either the actual amount you paid, or if you paid more than the US rate, then the US rate is what you're gonna be charged. So it works out being the lowest of these two. So whichever one is the lowest. Oops. Now, in this case, the foreign income taxes paid are the lowest, so this will be our duh. That will be our lowest one. So the US taxes that would be paid on this would be 316,000. The foreign income tax, the actual foreign income tax paid was 202,000. So they're going to get a credit for that 202,000. Okay. Coming down here, there actually is a choice. You can take the foreign tax deduction or the foreign tax credit. Now, in this case, it's going to look kind of silly because there's the credit's going to be far and away the better way to go. Okay. So, so the foreign income source. So this would be 1,265,000 for both of these. Bold all these. Now, deductions. You can take this as a deduction. You can take the 202,500 as a deduction. Say, hey, these are expenses that we had in foreign country, and the copying is not working. Let's try this again. And so we're going to take this as a deduction. Over here, the deduction would be 0. Yeah, because we're going to take a credit instead of a deduction. So the home country taxable income will be $202,500. So 1,062,500. And that should look familiar. This one will simply be the entire. Okay, so income tax, before the credit will look like this. US rate is 25%. So 25% times that. $265, $625. And this one we actually already did. This one's going to be the 316. Tax credit allowed is 0. And here, the tax credit allowed is the 202,500. So the net taxes payable will be $113. Yeah, okay. So would you rather go with the deduction or with the foreign tax credit? Which would you rather pay, through 265 or 113? So you'd opt for. So you take the tax credit. And by the way, just in general, credits are way better than deductions. Because deductions, you only get part of it. You know, in this case, you only get 25% of your deduction reduces your taxes. Whereas you look over here, this is 1-to-1, 100% of your credit goes against your taxes. So credits are virtually always better than deductions. Question on that? Now, an obvious question is, well, why do we even have these deductions if nobody's going to take them? The actual foreign tax deductions are a little bit trickier than here. This is kind of a, somewhat of an easier case. They can include all types of taxes rather than just income taxes. So now it will take a whole bunch to make up for, it would take 4 to 1 basically. For it to make up for and in the case I showed you for the tax rate to even kick in, then it would be better. But if they have a whole bunch of things like sales taxes, and they may have usage taxes and value added taxes and all those sorts of things, those get included. Those are beyond just the income tax. So a lot of times they'll have, very high sales tax or transfer taxes and things like that. That will be added into the deduction that won't count towards the tax credit. And anyone who does taxes, foreign taxes in all these different countries, even including the United States, is like, no country is clean. They all have little ways of inching up that taxes because they want the money. So it's not unusual to have, say, a low corporate rate, but the actual tax that is charged when you look at all the taxes, the sales taxes and all that kind of stuff, usage taxes, that they could add up. It is possible that for some companies the deduction is a better way to go, but for most companies, and this goes through virtually all of taxes, your credits are much better than deductions. Credits are much better than deductions. Okay. Go ahead and do problem number 2. The summer one, obviously you can have one of these in the test. Now, I'm just gonna give you a heads up on this one. Notice that the Australian rate is higher than the US. So the Australian rate is higher than that in the US. So that, and basically the US, compared to this one, where the British, the British rate was less than that of the US. So it's sort of like there's a 10% more tax basically that comes down here. It's a little bit not quite that clean, but there's about 10% more taxes that you'd have to pay for this. Whereas down here, it's kind of going the opposite direction. They have a higher effective tax rate than the US. 237. No, 2736. Okay, so we paid out taxes at 0.85 rate. The net income, the rest of the net income was at the average rate. We're gonna add these two together. $3,000,000. Thousand. Multiplied by the US rate, which is 21%. You could also just plug it in up here. Okay, so we had to pick the lower of these two. So the foreign tax credit limitation is going to be let me make this a more reasonable size. So in this case, even though we paid more taxes to Australia in dollars, we're not going to be able to write that off because we're not going to pay the extra money to fund Australia's government. The US isn't going to give you money to pay them the taxes. So this will be our foreign tax credit. Oops. And again, you kind of knew that this was going to happen or would likely happen because of this. We charge less than they do, so we're not going to let them write off, more than we would charge for income taxes. The most you can charge is up to what your tax bill would be. So we come down here, if I do this right, those will come out to be zero additional taxes. But let's go down here and do this. Okay. Deductions for all foreign taxes. Now we're going to have that 816. That's going to be for all foreign taxes. Because again, this is not the tax credit. This is just a deduction for the foreign tax credit, so this, and this would be just be zero. Okay, so home taxable income will be should just be this 2736. Well, that's way better. Yeah, it has to be in right. 27, yeah, same number. Okay, income tax before. The US tax rate. $574, $560. Oh, rats. $745, $920. Tax credit allowed. $745, $920. Look familiar? All right. So for this one, the tax bill would be 574. Single 5. And the additional tax here. Oops. So would you rather pay 574,000 or zero? If you're like me, you want to go with the zero. Any questions on that? And again, just in general, tax credits are way better than deductions. Not all the time, but a vast majority of the time you're going to find those. These foreign tax credits will often, they'll just be FTC. Oh, yeah, I know for a second. If you look on financial statements, they'll say FTC, and that'll be the foreign tax credits. And by the way, this just came from. Okay. Foreign taxes, just in general, they are very complex. I'm sure you've seen our tax code, and it's a nightmare. Every country is like that, and so converting those into U.S., amounts and all that is a real trick. I would. Hey, that's not me. I was an auditor, so I don't know. This is where I went into. I was interested, but a really good field is tax. And I can tell you this one thing about corporations that's they tend to look at people who are good at taxes differently than the rest of us accounting folks, because a lot of times the people who can do the taxes are actually saving them money, dollars. They're, for better or worse, the terminology, they're productive in that they can generate profits, whereas things like accounting, we don't really generate profits doing accounting unless we're doing something illegal. But in accounting, we don't really, the accounting department in General Motors doesn't make any money for General Motors. Auditing, internal auditing can make money, finding things. Sometimes we had an auditor that I worked with that found a $9 million error in a contract. That was like real cash that came in, but for the most part, they're not that big of a cash center. So anyway, companies look at you very differently if you're really good in taxes. A lot of consulting goes into taxes and that sort of thing. It's very complex, which if you are in it is a really good thing. Things that are complex, people pay a lot of money for. Things that are easy to do, they generally don't. So taxes is a really good field to go into. And in a lot of companies, even when they were cutting back on, all kinds of people, that they in accounting and even in auditing, they cut back. The taxes, almost all of them have risen. It's been a pretty stable part throughout the years. More so than I did regular accounting or auditing. Okay, another one thing that's kind of strange is what they call repatriation of dollars, bringing about dollars back to the United States from other countries. And it's kind of a funny thing, the repatriation. If you're wondering where that term comes from, is because the investment was made. It's sort of like our dollars left the country, and now the dollars are coming back. It's almost like with a person, if they leave the country and then they come back, they're repatriated with it. But anyway, so repatriation. Now there's all kinds of hooks and stuff with this, because there are rules about bringing money back in. Now, what we're going to do is basically look at just the exchange rates and see about the gains and losses on the exchange rates from the repatriation. But there are sometimes that they can be really big dollars, and companies have gotten very sneaky, maybe not sneaky, but creative, in getting money back into the country without having to pay taxes on it. And they do it from any number of ways. One way that they do it is have the subsidiary loan them money. Now, notice if they own 100% of the subsidiary, that's really loaning money to yourself. So, but they would take the money back in and say, okay, no, that's a loan, and paying interest on it. Yeah, who are you paying interest to? Well, myself, because it's, we own the foreign subsidiary. So there's been all kinds of shenanigans and stuff like that for people that try to do it. And there's there's law firms that do nothing but looking at bringing money, foreign taxes and bringing repatriation of funds back in the United States. Okay. So let's go here. The Milliken Corporation repatriated €1,000,000 and converted them to US dollars. What would the gain or loss on the repatriation of the euros? Okay, well, notice that on average, these, if you talk about money coming in throughout the year, that on average it would be 115. So anything that's in your income statement would be translated at that 115%. Well, actually, it is actually 115%, but 115, $1.15, I should say. Now, when they brought it back in, though, they got a little bit extra. So notice that this 1 million euros were earned and brought in as taxable at $1.15. However, when they actually translated the cash into US dollars, the rate was 121. So there's a difference there. And so they'll pick up that difference. Now, you'll notice that they got a little bit more dollars than on average, right? Throughout the year, they would earn 115. Well, when they transferred these, they got them in at 121. So are we probably looking at a gain or a loss on this one?
Okay.
Yep. Yeah, this is going to be a gain because we're picking these up at a higher rate than the rest of the income. So we would take I'm just going to copy it. I'm teaching you guys how to be lazy, a very important skill. So there's zeros. Now we're going to multiply it by 121 minus 115. So that would be the additional income that we had from this above, more than the 115 that we have on the books for when we actually earn those euros. So whatever that comes out to. 0.066 cents. So this would be a $60,000 gain. And they'd have to pick that up in their income. So the repatriation themselves, you can either have gains or losses on it. And generally speaking, if it goes up from the average, it's going to be a gain. I think the one down here I have to go down. Yeah. So this would be a gain, and this would be picked up in your taxable income. This would also be included in the taxable income here. This would be included in that if they had some. If these two were connected, it'd be included in that. 3,552,000 plus 60,000 if these are the same, companies or whatever. Okay, coming down here. That's the wrong date. Nope, that's the right date. Okay. So October 15th, they brought in their average. So notice that they had the average on the books at 75 cents, but when they bring it back in, it's been reduced to 72 cents. So when we bring these Singapore dollars in, We're going to bring these in at. You can probably put it as a negative. Um, $120,000 loss. And this would be in taxable income. It would be a reduction of taxable income. Because we actually lost 120,000. Bringing those back in. So this will reduce the taxable income by 120,000. But there's a whole bunch of rules and stuff on repatriation of funds. Like a few years ago, they had a kind of like a it's kind of like you do for parking tickets, where they say, okay, if you pay your tickets today, you don't pay any penalties on it, but you just have to pay the I don't know, like a holiday or whatever. But we had kind of like a holiday year where they try to get a lot of the US dollars back into the United States to build the United States economy and that. And so they allowed companies that had a lot of funds and a lot of foreign funds in other countries to bring money in. There was some incentive for them to do that. And I think the biggest one was Apple. Apple Computer, their European subsidiary, their European branch or whatever you want to call it, was headquartered in Ireland. And talk about a good deal. Ireland gave them a 0 corporate tax rate to locate there. And they did this for a reason. They wanted all these tax and stuff to be there, and that they'd have, the people working there obviously would be taxed, and that, while the company wasn't taxed, they would still collect a lot of tax from, the companies and employees and all the transportation and housing and all this other stuff. So anyway, they had 0 taxes on it. Well, when they were going to bring that in the United States, so they were going to get hit with the entire tax. And so they said, and it was up to $350 billion in cash that they had sitting over there, just waiting, so they could bring it in. But I'm not sure exactly how that worked out, if they actually went through with it or not. But they were going to bring a lot of it back. It was a real interesting case too, because the European Union, they kind of have a lot of say in the taxation, and they actually had a court case where the government of Ireland was awarded $9 billion in taxes, and they refused it. They didn't want to take it because they wanted to keep this deal that they had with Apple. But anyway, like I say, when it comes to taxes, there's no real clean way of doing it. But again, it's a really good career to get into, especially foreign taxes and all that. Any questions? So this is all we're going to cover in this chapter. There's a whole bunch of stuff in there. Literally you could spend many semesters just on foreign tax stuff. But anyway, any questions on the handout? Oh, okay. So let me share my screen that I'm usually stingy with. So in the textbook, there's a problem 17. I think it's called I think it's Avio. I don't know how you pronounce it. Avioco. I don't know. But anyway, it's no, not that. No, not that. It's this problem, and you just have to figure out the foreign tax credit. In this case, they have 2 countries, but the idea is exactly the same. What would they have for determining their foreign tax credit? And it is number 17. So problem 17 in the textbook, and it shouldn't take you too long. 5-10 minutes. Any questions? Okay, so next week we're going to chapter 9. And yeah, so this is chapter 8. So 8 and 9. So next week we'll start in on chapter 9. And so the test is on chapters 8 and 9. So we'll see next week where we're at. We'll have the test. I think we're on track though. I think looking at the syllabus, we were doing okay. So okay. Let me names down. And I will add the extra credit points onto your tests. Okay. Any questions? Hey, have a good night. See? 7, a little after 7. All right. And even less than that, because the first 8 minutes I was just, babbling incoherently. So all right, I will see you guys in a week. Good night.